After inflation cooled off post-COVID and central banks loosened monetary screws, policy rates look set for a downhill run. Then the tariff war hit, jacking up steel, energy, and commodity prices and forcing a sharp U-turn in monetary policy. Central banks walk a tightrope between inflation and unemployment. Raise rates and borrowing costs climb. Households spend less. Demand cools and prices ease. Cut rates and credit gets cheaper. Businesses invest. Hiring picks up and jobless numbers fall. Here's a headache. No one, not even the Fed, knows where the tariff war goes next. Commodity prices swing week to week, so projecting where headline CPI or the unemployment rate will land is extremely difficult. Result? Central bankers keep rates elevated until they can tell whether tariffs will stoke inflation or choke employment. This U.S. uncertainty radiates to central banks worldwide. Elevated rates mean bigger mortgage payments, pricier auto loans, and painful credit card APRs. But they're the only blunt tool to restrain inflation expectations while the trade smoke persists. High rates squeeze sectors that rely on cheap financing, real estate, tech, and other growth stocks. The upside? Those same rates boost yields on investment-grade bonds and even regular savings accounts at your bank. Old case. Tariff truce cools input costs, headline and core CPI rollover, while the unemployment rate stays near cycle lows. Central banks pivot dovish, rate cuts land, risk assets rip. Bear case. Tariffs escalate. Commodity prices spike, inflation stays sticky, and unemployment ticks up. Policymakers hold or hike. Rates, growth stalls, valuations compress. Rates stay higher for longer until inflation re-anchors or labor markets crack. Track monthly CPI, weekly jobless claims, and every tariff headline.